Hey, everybody. Welcome to the Data Driven Real Estate Podcast, the podcast for real estate professionals dedicated to driving business success using data. I'm Aaron Norris, and with us once again is co-host Sean O'Toole.
Aaron, thanks. This is going to be another good one. I hope we got a lot of questions after the last one, so hopefully we can answer some of those.
Yeah, everybody wanted to talk about how you disappeared in 2016, why you stopped talking, and really wanted to have a little bit more insight because of the pandemic. A lot of people are very worried about the strategies of owning rentals right now. Just where is the economy going to go? So why did you stop speaking in 2016? I guess that's a good place to start.
Yeah, jump right in, huh?
Yeah.
So, after the foreclosure crisis, ended up on 60 Minutes and ended up talking a lot about foreclosures and then housing affordability, where the market was headed and all the rest. Kind of like your dad got a really good reputation for letting everybody know to get out in 2006. One of the things that I said was foreclosures are going to slow down faster than we think, and a lot of people were surprised to hear that in 2009, 2010. But I saw some regulatory changes that turned out to play out. So fast forward to 2016, right? I've been talking economics for a solid 8 years, and I realized that for like about 3 years, I was saying the same thing, and that things weren't really changing, and I didn't think they were going to change until we had another event, as it were. So, I basically did kind of my last rounds with the real estate investment clubs and realtor associations and brokerage offices and mortgage companies, and kind of laid out what I thought was going to happen from there. And I had three primary takeaways.
You did. So let's go through those because I last heard you speak at the Coachella Valley Real Estate Investors Association. Hi, Janet and Larry. We had dinner a couple weeks ago, and I was telling them this. And yeah, you had three takeaways. Yeah, let's just, I guess, start there.
Yeah. So the first one, right, is that, we're having increasing debt. And debt was going to be a drag on growth overall. And, it's a long story. We can start back in the 1970s. But just on that one, right? In the 1970s, we had this period of really high inflation. We got to really high interest rates, and we kind of deflated. When you have periods of inflation, right, the dollars become less valuable, so does the debt. The debt gets kind of compressed in these periods of high inflation. So we had very little debt, very high interest rates. And from the 70s to today, if you kind of look at interest rates, they're in this kind of trajectory. It's not a perfectly straight line, but they're going down, down, down. And as that line goes down, right, we can take on more debt for essentially the same payment. So you can think about that at the household level, right? My income may not go up, but if the interest rate goes down, I can take on more debt, right? And same thing for corporations. As rates go down, they can take on more debt, stock buybacks, whatever, yeah. Right? And same thing for the government. And I really believe that's what's fueled our economy now for 50 years, right? Or 40 years, since the late 1970s, 40 years. So, I'm a tech guy, so I'd love to say that it was tech that fueled the economy. But if you look at the line of increase of debt and the line of increase of GDP, those two are far more correlated.
And if you're not on YouTube, I will put the chart up that he's talking about, because it is very interesting to sort of see the lines just sort of cross. Yeah, for sure. I remember Dad likes to tell the story is he got into real estate investing in full time in 1980, timed the market perfectly, and got in at 17.5% interest rates. He refied his owner occupancy home so he could be a full-time real estate investor. So you look at the chart of interest rates, and it was literally probably the worst day on record. But when you say just the inflation piece and the devaluation of debt, so you're saying, 1 year it's 15% and then it goes to 16. If you were the owner of the debt at 15% and then it went up to 16, nobody's going to want your 15-year note. So
They will, but they'll want a discount to
Right.
make it pay a 16% rate. So that's where the debt itself is getting deflated, right? In that situation, which we haven't had for a very long time. That was the 1970s.
Right. So, okay. So we've been building an economy based on cheap money over the last 40 years. I can definitely see that come. Okay.
And we're getting closer and closer to where we can't get cheaper,
I was going to say,
right?
like, we're
When you
zero.
go from 17 to 16 to 15 to 14, right? Lots of room there, but now we're pretty close to zero. And so that was a big part of my thinking after 2008 is like, holy moly, how do we rescue things now if we can't just, go cheaper interest rates and create bubbles? And, where we really saw this was this kind of bubble crisis cycle that started in 2000 with the housing crisis, or sorry, with the dot-com crisis. So we had the dot-com bubble in 2000, right? Followed by the World Trade Center and that, but a lot of stuff going on right then. So we had this major crisis, this major drop in especially tech stocks, telecom stocks, et cetera, unemployment, lots of impacts. And we kind of rescued the economy by blowing up a housing bubble, right? That was fully backed and supported by the Fed, in fact, cheered on by the Fed, right? And so we used this housing bubble to save us from the dot-com bubble. And then the housing bubble kind of collapsed under its own weight, right? And the Fed bought mortgage-backed securities and put in a lot of stimulus we put a lot of stimulus into the economy and the rest, right? And so we kind of, bought ourselves out of that housing crisis with really, you see the lines of kind of all debt, student loan debt being the fastest growing, corporate debt, government debt, even mortgage debt has kind of come back, despite everything that went on during that time. But, debt just skyrocketed after 2008, right? And that's kind of how we rescued ourselves from that crisis. And so my second big conclusion after debt will be a drag on growth. We're going to see slower growth, harder to achieve growth, right? Is that the next time something goes wrong, the Fed's going to act even more aggressively. And I joked at the time, my cartoon was Janet Yellen standing behind the Honey, I Shrunk the Kids shrink ray, and that whatever the problem is, she's going to shrink it. And, and I had a whole bunch of different possible things, black swans, as they were, that could go wrong, right? We could have another bubble blow up burst, but we could also have other things, right? Cybersecurity incidents, terrorism incidents, lots of things can cause these dislocations.
Can you define black swan if somebody hasn't read the book? How do you define it?
Yeah, so a black swan is there are these things that happen that are unexpected, but unexpected things always happen, so we should expect them, right?
Right.
So, 9/11 was a black swan. The internet actually was a black swan, right? So, think about if you're selling modems and the internet comes along, right? Maybe modems is the wrong example, but right, like things get displaced, right? The internet's certainly been a black swan for cable TV, for telephone, for lots of things, right? So it's these things, they're not necessarily bad, but there's these things that come along that cause unexpected change and consequence, that often can be quite negative, at least for some. What's interesting though, is one of the ones that I had on my sheet was pandemic, right? So I had the guys in the full hazmat suits and all the rest was one of my possible things. And, that is one of the ones that, I felt at the time could be one of these things that could happen.
Which I have to say is very random because I don't know. I'm 43. I don't recall anything like this ever happening. So for you to pick that one out is very interesting.
Well, it's hardly like I picked it, right? Like, I mean, Bill Gates, and back in 2016, I think he'd already done his talk, and lots of people were talking about it's only a matter of time until we have one. The fact that we weren't prepared for this is disgusting, right? Like, it's just, it's inexcusable. Um, it was going to happen. It was just a matter of when.
And the fact that globally it's been anyway. So
we'll come back to what's going to happen. Let's
keep going. So
basically, I said something else is going to happen, and the Fed is going to step in. So that was my second thing.
Okay.
And then my third big thing that I thought was important for everybody in the real estate community to understand is that automation is accelerating, right? So productivity and wages went up kind of in lockstep into the 60s. And then they separated and wages went flat and productivity continued to go up, right? And that happened basically with the introduction of business application software. And as automation has continued, that's continued, right? Anybody who thinks we're going to bring jobs back to America, you know, manufacturing jobs and the rest, we could bring manufacturing back, but it's not going to bring jobs back in the way that it was in, you know, the good old days, right? China's going to have as much problem with workforce disruption from automation and progress as we are, right? So it's, you know, that's not a war we even should be fighting or talking about. It's not the future.
I think
hand assembling stuff is not our future.
And you had something in the presentation saying that we had only lost a certain percentage due to exporting it. It really had a lot more of the loss of jobs was strictly because of automation. So I think there is that narrative that, oh, we're going to bring those jobs back and we're going to, you know, get those union paying manufacturing, when automation and robotics at this point, those are never coming back.
Right. Yeah, no, I think I'm just looking for that. 25% of manufacturing job loss is due to globalization. The other 75% is due to technology and automation.
Okay. I know we'll go back there as well, because I have a lot more concerns.
Here's the bigger one that people don't realize, right? US manufacturing output is at an all-time high. US manufacturing employment is lower than it was in the 1940s.
1940s?
Yeah. So it's not, right? It's not that we've lost manufacturing. I mean, we've lost some of this high labor, cheap labor manufacturing, right? Jobs we probably don't want to do anyways. But our actual manufacturing output is higher than ever. So anyways, there's a lot of bad information and bad data around all of that. But I think it's important for the real estate community, right? Because we are seeing Opendoor and iBuyers and Zillow and all this disruption. And I think that even in real estate, which is not one of the most forefront in the technology and automation industries, right? Most at the forefront. I think it's important for those of us in the industry to be thinking about how do we work more efficiently? How do we do that better? So those were my big three things, right? Growth's going to be tough. We're going to have something else come up, and we're probably going to have things be pretty stable until that happens, right? And when it does happen, the Fed is going to come out with their shrink ray, and automation is accelerating. And if you want to be successful, you should get on that bandwagon rather than fighting it.
So, got it. And in 2016, what were some of the things that maybe strategies that you were talking to investors or about doing to make sure they were taking advantage of the market?
Yeah, so in a market that's not growing, right? So based on growth slowing, there's really just one way to win, which is to take business from your competition, right?
Nice.
So, you know, it is what it is, right? There's a certain level of business, there's a certain level of transactions. If you're a realtor in California, there's 400,000 transactions that happen a year, if you want more of them, you've got to take them from somebody else, right? It's that simple. And, so tougher competition, focusing on the competition, focusing how to use, again, back to the automation to have an advantage over the competition, I think were really important things. And then bigger picture, I said, be prepared. Don't get caught like many of you got caught in 2008, right? We will have another dislocation. I don't know what it will be, but we will have something's going to happen. Terrorist attack, cybersecurity event, major utility outages, there's so many possibilities. And don't, you can live in fear of those things, right? Or you can say, you know what, somebody, who was it? There's a Schwarzenegger was like, you shouldn't have a plan B, right? If you have a plan B, that's all you'll ever accomplish. You just got to go for your plan A, right? I'm all for a plan A, but I believe in safety nets. Like I'm all good with the safety net, right? And, so my kind of advice was, hey, swing for the fences, go climb that big rock, but wear the safety harness, right? So that if something does, that rock comes loose, something happens, you're not dead. So basically saying it's going to be a pretty stable market. It's not going to be a high growth market. Go steal from your competition, business from your competition, do better than them, focus on automation, and just know something's going to happen at some point.
Okay, so we're back 4 years later. Let's sort of dissect those three things that you were talking about. Just the leverage loan piece, what's happened over the last 5 years. You look at the student debt. What's interesting is when you look at the chart, and I'll make sure on YouTube that we show this, is that, the breakdown of the debt that's exploded. What's interesting is that the mortgage debt finally started to uptick, but you see that the GDP growth is no longer attached at all to the leverage. That's concerning.
Yeah, so you had debt and GDP kind of all going up together, and then suddenly most debt just goes straight up, and GDP is just kind of still, it is what it is, right? It went down a little after 2008, and then it's just been kind of steadily ticking along as it's always ticked along. And, so yeah, for sure.
And you've got some European countries looking at negative interest, have deployed negative interest rates, and I haven't looked at any housing pricing charts for those areas because it's still less than a year old, I think, for the markets that I was looking at. But do you think that'll happen here in the U.S.?
Yeah, so negative interest rates, that's a good one. I don't think it'll happen. Our next black swan is here, right? COVID.
Right.
So, if there was a time to hit negative rates, right, it'd probably be right now, right? And I don't know, it looks like we may avoid it this time, right? They've poured the gas on in enough other places that they haven't done that with rates. And I understand there's some contagion possibilities with pushing rates down. So you just say you have a lot of funds in money markets, right? And if you push rates down too much, people will pull their money out of there, and that could cause a run on bank, which causes other problems. And so they've got to play with all the pieces of the puzzle, right? I'm not an expert in this, right? But they've been buying corporate bonds this time, which they didn't do after 2008. That's big, that's new. You've got all these other things that have been going on. But I think, just to take one little step back, right? So the next black swan came, it's COVID, and massively deflationary, right? So if you think about, the economy, like suddenly every boat is leaky and sinking, right? Like it is just a very deflationary, bad hit. People are staying home. They're not spending as much. Bars, restaurants, right? It's just awful. And so, when something like that happens, you have to have some response, right? You don't have to, but you should have some response or some strategy, you know, as monetary and fiscal policy, right? So the Fed and Congress basically should have some strategy of like, how are we going to address this? And there's just really four options, right? So one option is austerity, right? Just we don't do anything. We're not we're gonna tighten our belts. We're gonna live with it, right? And we're just gonna suffer this deflation.
Now, Greece tried to do that. It didn't feel like that worked out so well.
Yeah, Ireland did it though somewhat successfully, right? So it depends on the degree and stuff, right? I think a year ago would have been a good time to think about or 2 years ago or 3 years ago, would have been a good time to think about a little austerity, right? Economy's cooking along pretty good, right? We could have tightened our belts a little bit without very much pain, right? So
that's sexy to run for political office. I'm the austerity focus, you know?
Exactly.
Yeah.
Exactly. Which is why all democracies fail, right? Because we don't vote for doing the right thing. We vote for doing the easy thing. And, you know, so so we're going to face that at some point in time. So austerity really hard, right? Especially when you've already got this huge deflationary force to not provide some sort of support into that, super hard, not suggesting it's what we should be doing at all. I don't think it's a bad thing to do a little bit of it in the good times, balance the budget, get things right, kind of even build some reserves. State governments, you actually have to have a balanced budget. You can't print money. So if you're in a state government and listening, like the next time there's a big boom, right? Don't blame Prop 13 when it goes bust. Understand you squandered all the money in between, right? Like, awkward. So, right? Awkward, yeah. So austerity. The next one is, you know, debt restructuring and defaults, right? So you have this major downturn and you let people restructure their debt, you let them default, or you just have defaults and you kind of let that go. You pull a lot of debt out of the economy. That allows then people to start spending again because they don't have to repay debt, right? And that gets the economy going again and you can get things restarted, right? So the tough one there is, right, you're really picking winners and losers, right? Holders of debt, which tend to be fairly powerful folks, like are losing and losing bad, right? And debt, you know, borrowers, you know, are kind of getting a free pass, right? They may lose their asset or whatever, but, you know, perhaps they're getting a free pass. Perhaps they're, you know, they get some sort of penalty, but still, it's an ugly, tough thing and picks winners and losers and can create a lot of strife, right? So not a great one.
Okay.
The next one is wealth redistribution, right? So you basically tax those that have money and give it to those that don't, right?
Already talking a lot about that as we're going into the election season. I expect we'll see a lot of that.
This is going to happen as part of this at the state and local level.
Yeah.
I don't expect it at the federal level, but you know, I think California went from like a $4 billion surplus to a $54 billion projected deficit.
Yeah.
The state of Nevada is talking about adding an income tax. You know, you got a lot of stuff going on there. There's a lot of folks a lot of states, a lot of local governments who aren't going to be able to fill those holes without picking somebody's pocket. So we're going to see, well, the primary form of wealth redistribution is taxes. And we're going to see some of that as a result here for sure. The final one, number 4, is to print money and devalue it, right? You just pump money into the economy. And that's what we're doing, right?
A lot of it.
and everybody has agreed, right? The Fed has said we have to do it, right? The Democrats have said we have to do it. The Republicans, there's been zero debate about that's the one out of the 4 that we're choosing, right? We're going to just print money like mad and go for it.
How many T's? That's the only thing they're fighting about. So I know we're talking. Trump just came out this week, said he's looking at another trillion, and they're back later in July. So yeah, for sure, more is coming.
And you know what? We're so fortunate, and this may sound terrible. We're so fortunate that this crisis that hit us is a worldwide crisis. Because guess what? Every central bank, every government's doing the same thing. So it's not going to put us on a significantly worse footing, right? Everybody's doing this for the most part, right? Especially folks that have their own currencies, right?
Right.
You know, anyways, what's happening to countries that don't in this kind of a situation where, you know, we print lots of money and you know, they still have to pay back. It's not good. So in any case, that's clearly what we're going to do. And, you know, and that's where we're at.
All right. Well, I mean, you print all that money. I mean, obviously there's a big conversation about inflation that impacting prices. If you own real estate, you're in the real estate community, that gets you excited because real estate is a basket of commodities and prices go up. I mean, are we looking at inflation?
Yeah, so when you have this much massive stimulus, right, you're going to have massive inflation, right, which basically is the value of the dollar goes down. Two interesting things here, though, right? We already have massive deflation from COVID.
Right. Nobody's
So
spending money.
you add this inflation, and what you get, hopefully, if we do it right, is reflation. So not inflation, we just get things back to where they were. We reflate the economy. There'll be a dip in between, but if they do it right, that dip will be shorter and less severe, right?
Okay.
And that's inflation. So instead of having massive inflation on the other side of this, if they get it wrong and do too much, we will, right? If they get it wrong and do too little, we still have devaluation, right?
Right.
Inflation. And if they get it right, we reflate and we get back to where we were.
Man, this is going to be so interesting to watch. We talked last show about urban centers, lots of articles coming about winners and losers when it comes to people rethinking their urban existence. Was reading an article I shared with PropertyRadar today, all the employees about New York and specifically people leaving en masse, how that's going to impact commercial real estate prices. And then just knowing, because we're in Florida and watching prices and the demand, and it's just going to be really interesting to see how people handle this and how long this lasts. Because I mean, if we do not control the pandemic, I don't think people have a choice, but like, I'm uncomfortable here. This is not sustainable. At some point, if the government doesn't continue writing those checks, so right now we're in July, the government's looking at all the programs. Do we extend the pandemic unemployment $600 per week? It ends at the end of this month. You know, holy cow, what happens if in August comes and this continues to be really bad and there's no end in sight for controlling it?
So be clear, Republicans, Fed, Democrats, they'll continue to provide stimulus for as long as necessary. Like, there's no question in my mind about that. So, you know, they're going to keep trying to hit reflation. And, you know, because your three options just aren't really viable options, especially for a politician, right? Like, so as a politician, it's really your only thing you're going to do. And the bummer part is, right, is the government's not very good at this, right? So you take something like the $600 a week extra unemployment, right? It's awesome in terms of, if you look at you know, kind of a wage equivalency, right? It's been great about keeping money in the economy and all the rest. A really good, successful program from that side. But now you're a small business, right? You're allowed to reopen. You need people to come work for you to reopen. And your people are saying, you're paying me $15 an hour, and I'm getting $15 an hour on top of regular unemployment to stay home and watch The Simpsons, right? I'm not coming back to work. You know, and then the employer goes, well, if I tell the unemployment office that I offered you a job, they're going to cut you off of unemployment. And then the employer goes, if you do that, right, like I'm going to badmouth you and I'm, it's leaving employers in an impossible situation, right?
Yeah.
So the government's just not very good at this, right? They're picking winners and losers. Like the intent's great, right? Some of the outcomes are great, but some of the outcomes are bad. Same thing with PPP, right? You've got companies that it's been absolutely wonderful for. They were able to keep all their employees on, all the rest. You've got others that, they can't bring people back because they're still shut down.
Yeah.
And maybe they'll bring them back and be able to use that dollars in that time, but it's not going to really offset all the income they've lost.
Yeah.
It's not going to make up all the expenses they've had, where they've still had to pay for all the things to keep their business ready to come back to life. And we're going to have a lot of businesses that aren't going to make it. Like there was probably a better way to do that program, right? And it's tough because we don't have good data. They don't have good data on, the IRS has some data, but really when you look at it all, like what's going to the owner, we don't want to write checks so that the owner can still go, sail in their yacht and go on fancy vacations, but we do want to give enough so that they can keep their folks employed, right?
Right.
We're just not good at it. So there will be winners and losers. And there will be winners and losers at kind of all levels and in housing.
Yeah, I think some of the European countries, instead of giving that extra aid directly to the people, it went through the businesses and with the goal of just keep your people employed. Even if they're not doing anything, we want the money to go through you,
Right.
to make them whole.
And cap that at the lost income, right? So
Right.
you will make up, as much lost income as you have if you keep all your folks employed.
That seems like that would have been a better fit, but
Maybe minus profits under, so if you were a super profitable company, we'll make up your income minus this, keep your profits, maybe even keep you at break even. We'll make up, income loss below your break even point to keep all your folks employed. Something. There was some better way to do it.
yeah, I'm sure the takers of the PPP weren't expecting public relations nightmares for taking the money, and now it's being shared with everybody, and they're like, oh, that's no fun.
I don't know. The money was put out there with a certain set of rules, and if you met those requirements, you should have taken the money. Like that was the point. Like what's the stupidest frickin' thing is that we still have $1 billion plus that didn't get used because people got afraid of the rules. The point, even if, let's just say, worst case, that money went into some fat cat's pocket, right? He's still going to go buy a boat. That boat, by building that boat, is going to employ people. Like it would be better to have it misallocated than not allocated.
Correct.
It would be better not to have it misallocated for sure. I'm not saying it should be misallocated, but people being upset that some of it got misallocated because they rushed it out a little, too quick. It's better they rushed it out quick, right? I can think you and I can sit here and, armchair quarterback how they maybe could have done it better, and hopefully they'll do it better next time, right?
Well, they have their shot when they get back, but going into election season, man, I feel like this is going to get uncomfortable.
Yeah, but they needed to do it. They needed to do something fast. They needed to get the money out there. It still was probably too slow. It's better they did it, and we shouldn't be picking on those companies.
Very true. So, well, let's try to bring this back into the real estate market. So Correlate Logic came out in the last couple of days, talked about how they're thinking, prices may decrease by 6%. And I just think it's so weird national numbers are so hard because I think it's going to be so local. I don't know how you're feeling about that.
Yeah, I think there's a lot of truth to that. Like we're seeing quite a bit of different issues, right? So let's just walk through demand and supply, right? Because supply and demand kind of at the end of the day end up impacting housing. And I think a lot of these things are coming up, right? So on the demand side, right, people can now work from home, right? And so they're going, well, why am I living in this dump that's near my job when I can go live where I've always wanted to live and work from home, right? Especially for all those tech companies that have said, you can work from home permanently now, right? So I'm based in Tahoe, as you can see that picture, and uh, we we're seeing multi-million-dollar houses that have sat on the market for a year get 6 offers.
Wow.
Right? Like it's going crazy. My guess is that full-time residency here doubles in the next year.
Okay, well, that's a headline. Well, because here's why. I part of my job is reading the news every day, and some people are like, "Oh, these secondary housing markets are going to get hosed." But basically, you just said at a very high price point that may not happen. That's really interesting.
And well, what are secondary housing markets? They're places where people want to live, right? They have that secondary house because that's where they want to be. And their first house is their place they don't want to be, right? So anybody who's thinking the place you want to be in a work from home world is the place that's going to be hurt, like no, you don't have your brain on.
That makes me laugh because it was such a simple response. You're like, well, duh. That's fantastic. I actually want to live there. Yeah, all of a sudden we're looking around the room like, I don't want to live with you anymore, and I don't want to live here anymore. So
And that's, I think those are two, right? Like, so household separations, I think we're going to see a massive spike in divorce rates, right? People
increase.
have been forced together in ways that they haven't been ever in their life and spent more time together in the last little bit. And I think that's going to make some folks a lot closer. And I think it's going to have some folks go, oh, heck no, I am done, right? We're separating, right? And so that's going to create demand. We're going to see a move from dense to less dense, which is going to create demand in those less dense areas. It's going to create supply in the dense areas, right? I think people realize that even with a reflation, when you print this much money, it doesn't all leak out in the right places. And some people would say right now that cash is trash because to any degree, we're still devaluing dollar. Even if we just get to reflation, right? When you print this much money, money's not worth as much as it was before. And some people would prefer to have hard assets, right? So exotic cars don't seem to be dropping that much in price, right? Art doesn't seem to be declining that much in price. Real estate, desirable real estate, is we're not seeing declines, we're seeing increases in many cases, right? So there's a desire for hard assets, and we're also seeing lower interest rates, right? So that's also bullish for demand and pushing prices up. Now, not that it's all good, right? Certainly, folks who own short-term rentals have been pretty massively hit. A lot of folks are starting to booking again. I think a lot of folks will survive. Some folks were really smart. I have a friend that as soon as it all started happening, he started advertising. He had 20 plus short-term rentals. He started advertising them all as in Escape New York, fully furnished, right? I think he's going to end up doing better with these long-term Escape New York renters than he did with his short-term renters financially, because he didn't have to keep cleaning them and turning it over and doesn't have all that stuff, right?
Right.
But certainly some short-term rental folks, there's definitely a lot that got really hurt, right? And some of those aren't going to survive. They're going to need to sell. So,
It's funny you say that. I was on a talk, and I was speaking to realtors, sort of a presentation on this about PropertyRadar, and then afterwards I hung on the line to talk about the haves and wants, and she was actually said, Orange County, getting rid of my vacation rental. So
yeah.
at the price point, a lot of times it didn't make sense. I mean, unless you can get those high dollar amounts, yeah. So, but what you said is interesting, because I always think of demand too and price point. In San Diego, anything under a certain price goes really fast. And then in brackets, you go over $3 million, those could be hanging out for 2 years. So a lot of real estate investors I know have very strategically pulled out of that category over the last couple of years. They're not doing it anymore. But it's going to be interesting to watch. Okay.
Interesting to watch. Now, and this is the most depressing one, right? Like, our worst off households have been the hardest hit, right? They've been the hardest hit by COVID. They've been the hardest hit by the economy. You know, they're just the hardest hit. I think what is it? The Fed said 40% of households under $40,000 a year in income, um, you
Wow.
know, have had a job loss. Um, you know, so that is definitely going to put a lot of downward pressure on the market, right? And we're going to see a lot of defaults and that. So that it's not all good news. I mean, we joke about some of this stuff, people getting divorced, creating demand, whatever. Not that that's good news either, but right, like, um, you know, like this is going to be a major downturn. It's going to be tough to recover from it. It's going to be especially tough to recover from if we don't, you know, get on top of this. Um, you know what's going on with COVID pretty soon, right? We have the absolute worst statistics pretty much in the world. Like pretty much everybody's doing a better job than we are,
Mm-hmm.
and you know, so hopefully we get to vaccine. Hopefully we get to people being a little more careful, and we get this thing slowed down, and we can get back to work. So, but until we get, you know, past that, it's a pretty significant economic hit, even with the stimulus. And again, winners and losers. We are going to see some losers there. I don't know how well dense real estate in San Francisco does over the next little bit here until we get past this. You know, lower income neighborhoods probably get hit pretty hard. You know, so yeah, it's definitely not all good news. Um, I don't think we're going to see a downturn like we saw after 2008, though, for housing, for sure.
That's that's good to hear. You know, this was my first full cycle, having gotten into real estate in 2005, and you know, starting to buy real estate as rentals. It's been an interesting journey, but I think back to that time period and being able to buy rentals in states like California for way below replacement cost is so interesting. I think part of my concern right now is going into the election season, and you see some of the bills that are coming up and knowing some of the concerns that were already a problem before COVID-19. So LA as an example, just released more homelessness data, and it has, I think it increased by over 10% again. And they raised billions of dollars with the HHH fund, and they're on par to hit an affordable housing unit of $530,000, and it's taken them 3 years to get there. So they were already looking at ways to address it, and now this happens. And so a lot of the state of California is just, man, I'm worried about cities that were too reliant on one industry, like schools. So was listening to the different CEOs of the California school systems come out like, yeah, fall's closed. So all those foreign students, they're not coming to town, which could definitely impact a lot of real estate investors, in particular in those towns that are really reliant. It's just scary. I don't think we've
On the other
seen.
hand, right, there's a lot of pressure on universities to open for the foreign students because if they're not open, they're going to send them home. So, yeah, that all that is pretty interesting right now. You know, we'll never solve affordable housing by building unaffordable housing, and everything right now, that's the fix, right? Like, oh, we need to build more unaffordable housing. Like, let's, you know, we're going to solve homelessness by building $500,000 housing units, right? Like, we have to go to shitty housing. And
Shitty
you know,
housing. We're gonna.
Title 24 and all the rest, we've made it too expensive to build. And we're going to continue to have, especially in California, we're going to continue to have a huge supply problem, right? When we have layers on layers and layers of local, state, county regulations that just make it so expensive to build, we're not going to have enough supply. Now, that can be very different. This is a national audience, right? So that's very different. And if you're in an area where there's high supply and you've got these things going on, right? It's a very different outlook for housing and housing prices in a place that maybe already had too much supply and not enough demand, or demand that was moving or leaving from that area. So it is definitely regional. We should talk about. We only have, I think, a handful of minutes left. We should dive into, having been the foreclosure guy on 60 Minutes back in 2008. We should probably talk about foreclosures a bit.
Yeah, I mean, are you expecting big
Curious.
foreclosures? Yeah,
What,
go for it. So, what are you thinking? I mean, there states like California, they're just put the kibosh on it. So, I think they're going to extend that for the remainder of the year, and other states follow suit.
on Fannie and Freddie and stuff, right? We're seeing plenty of foreclosure moratoriums, also eviction moratoriums. So even if you buy the foreclosure, you can't evict the folks, right? So it's like pretty nutty. So with regards to foreclosures, right? A minute ago, I said I don't think we're going to see another housing downturn, and foreclosures has a lot to do with that. So I think that's why it's important to touch on it. We will definitely see a wave of foreclosures. We've already started to see an uptick. Okay. And, with some coming back online, it never went to zero. We always had a few, right? It was always funny watching like the 1 or 2 or 4 guys a week that still bought deals, and they actually bought pretty good deals in a lot of cases because nobody else was going down to stand at the courthouse steps. And most things that you went down there for were postponements. So there were actually a couple of good little deals out there, but we're starting to see a little uptick now because the foreclosure moratoriums were kind of like for those affected by COVID, right? So you get some vacant properties, land, things like that. Those have been still foreclosing. But what we have been doing now since March is postponing all the normal foreclosures from the 5 Ds of foreclosures, right? Death, divorce, disease, drugs, denial, right? And so all of those have been postponing now for some time. And as these moratoriums come off, not a single one of these foreclosures will be due to COVID, right? But they've been postponing because it's too easy for a homeowner in a house to say, well, I would have caught up on my payments if it wasn't for COVID, right? So as a lender, you know that they haven't made their payments in 2 years, but you're going to wait for the moratorium to be lifted, so you're not in court arguing, why maybe they couldn't have come back up and made the payments, right? So we know there's going to be a wave of foreclosures as the moratoriums lift, right? Because they're just backed up, Our normal level of foreclosures every day, those aren't happening. So those will all come out in kind of a pop, right? Maybe not in a day or a week, but over maybe 2 months, we're going to see a little wave. Our foreclosure folks are going to have, some fun. It is quieter down at the auctions these days. And, it's important to watch because it could be, whatever that they decide, we're going to release these 5, release these whatever. And we are seeing a little bit of that now. So I do expect a wave of foreclosures, not due to COVID. Now, coming back to foreclosures due to COVID, you really need to look at your particular state and its guidelines. But we saw back in 2008, it wasn't unusual for it to be 1 to 2 years from the time of missed payment to the time of foreclosure, even 3, 4 years, right? So think about first missed payment is March, right? The first COVID-related foreclosures I think we'll see in most states will be, probably April, May, June of 2021. Wow. So it's out there a ways still. Okay. And while
coordinate, maybe.
What's that?
Takes everybody some time to coordinate, because you wonder if the federal government, the GSEs, will sort of be like, yeah, we can't dump this all at one time. Let's really be strategic about.
And that, I think right there, you hit the key thing. So we're going to see a wave of these folks that have been backed up. They're not going to see any mercy, right? They were already far behind before. Those are going to go, right? I believe we're going to see a bounce, right? And then things will probably come back to where they were 6 months ago. And just kind of a level. And then I think we will see another bump. It, it's going to be very different than 2008. In 2008, the regulators held banks accountable to get rid of bad assets as fast as possible. So the bank was expected to, declare default at the minimum number of days allowed in that state. Notice, the notice of default, notice of trustee sale, right? You were looking to do everything as fast as possible and meet the statutes, right, of that state. And then you went through all of that. You had an opening bid that was the amount owed on the property, which for that first wave of foreclosures in 2007 and 2008, especially 2007 through the first half of 2008, it was more than the property was worth.
Yep.
So the bank took back every single one of those properties, right? And, every single one of them went into their inventory. Now, what happens with that inventory? Same regulations, right? They have to dispose of it as fast as possible, which means putting it on the market and dropping the price until it sells.
Mm-hmm.
At the same time, those same banks have stopped lending into those markets or made it really tough to get a loan. So you've got this perfect storm of lots of inventory, hitting the market at the same time with no loans available, right? And they kept lowering the price until it finally attracted the bottom feeder cash buyer that went, holy moly, this is a 10, 12, 15% return if I just rent it out. Of course I'm going to buy that, right?
Yeah.
And those early deals, that's the kinds of returns it was. And then you had Waypoint and Blackstone and the rest and go, well, wait a second. If we can buy those properties at a 7% return, right?
Yeah.
We can bundle that together. We can get debt cheap, and then we can turn it into a REIT or whatever. And we get a pretty nice spread, even if that rent is only a 7% return. So they all jumped in the market, and now prices got support and started to come back up, right? We regulators won't make that mistake again. Mostly all the states kind of changed their rules. Most of the states now have rules that the banks have to look at, loan modifications and stuff, and have to look for the most economic outcome. The regulators are way more about that it's being more important to keep people in their homes than it is to, foreclose and get the asset back on the streets. And then I think banks and regulators understand that it's better to sit on the assets, rent them out themselves, than it is to dump them all in the market at once.
Agreed. And
without that motivated seller that can take that huge discount, right? There isn't going to be that available inventory at lower prices to see prices fall the way they did in 2008. I'm not saying we won't see a correction. We certainly will in some markets. People will have enough equity now after prices having gone up so much that they'll say, you know what, I want out of Timbuktu, and I'm willing to take a 10% discount. I'm willing to take a 20% discount. And if there's enough people in Timbuktu that agree to do that, we will see those markets come down.
Okay.
I think nationally, we will see, we will start to see some declines, but nothing like what we saw in 2008. There will be opportunities for foreclosure investors, but nothing like 2008, not where you can go down and pick your choice of homes that were built 3 years ago, right? That are brand new and perfect inside at, 50 cents on the dollar. We're not going to see that.
Well, in the debt chart, we had talked about the mortgage debt nowhere near some of the other debt levels. And now that we're at zero, if they make the strategic move to make liquidity and debt available for these. That is definitely a change. So that's good. I didn't think about that. Okay.
Well, and the Fed's buying up mortgage-backed securities like
Right.
crazy too. So they're providing a lot of support to keep interest rates down and keep the housing market moving. And
Are you
so long as IMBs, independent mortgage banks, don't implode, and the Fed continues to have the mortgage industry's back and keeps interest rates low. So there is some, if something blew up in the mortgage banking industry and rates went way up, all bets are off. But
okay?
if what we're seeing right now, credit's a little tighter, but rates are a little lower, if we continue to see that, I don't foresee we'll see a major downturn.
Are you worried about any other black swans?
Oh, of course, right? Every single other one that I had on my chart, I should pull that up, still exists today, right? And there's nothing that says we can't have a black swan on top of a black swan, right? Like 2020's already felt like that, right? With the protests and riots, and we've had, all these, the COVID and locusts, and like, there's been a lot going on this year, right? But, I think cybersecurity, terrorism,
International turmoil. I mean, man.
International turmoil, war, right? Automation is still impacting jobs, right? One thing, that I think we're not talking about a lot, right? But some of the reaction to COVID may make the unemployment situation, long-term unemployment situation, worse, right?
Sure.
If I can order from my restaurant at my seat with my phone, and I don't need a server other than somebody just to bring it out and set it on my table, but nobody have to come talk to me, right? What happens to wait staff, right? It probably changes. I need a different level of staff to just drop food on a table than I need to provide customer service and take orders. Now, I'm not saying every restaurant will go that way, but some will, right? Mm-hmm. I think some fast food restaurants, we're not going to see people behind the counter, right, anymore. Like we will see touchpads, yep, and probably some sort of cool UV light self-cleaning touchpads, right? So,
right.
Or we'll use our phone, right? Like, so we may accelerate a bunch of automation, right? And even the $600 a month extra check where people don't want to come back to work may force, some employers to go, you know what, I'm going to finally, we're hearing about this in ag, right? All this immigration stuff. I can't bring in folks, the visas that I used to bring folks in legally to help harvest. Well, a lot of the wineries like their grapes hand-picked, right? Better flavor and all the rest, but they can't hand-pick them, so they had to invest in machinery. Well, now they need to pay that machinery off, so they can't go back to hand-picking. They're going to have to use that machinery going forward. Wow. Right? So there's a lot of change still coming from this, and my favorite saying to my kids are, change is the only constant, right? Like, people don't like change, right? People hate it when we change our software, but change is the only constant, and if you're not changing, you're dying. And I think right now that'd be one of my bits of takeaway is embrace change, right? Think about how you put electronic locks. Realtors, think about how you put electronic locks on your doors, and a lot of you are already doing the Matterport and the virtual tours and all that stuff, right? Like the iBuyers kind of led on that, right? With people-less tours of houses. I think everybody needs to be thinking about those kinds of things because those changes are going to come.
I'm a big advocate of that, of watching the technology providers, because they've got some great ideas, and it doesn't mean that we can't borrow, rob and steal the same and mimic what they're doing. What are maybe some other opportunities? Because it's really a conversation about getting more tech savvy, and everyone's at home quarantine, so now's a good time. I've heard a lot of great conversation. Realtors only showing houses for people that are completely qualified. How?
You can get away with that now, right? Like, think about what a time saver that is for a realtor. Like, hey, I'd love to show you houses, but we have to qualify first, right? There's a lot of folks that have listings that are saying, we're not going to show the house until you've made an offer, right? So you need to be that serious just looking at our Matterports and our pictures and the rest, that you're willing to make an offer and declare a price, right? And once you've made an offer, then we'll show you the house. You couldn't have gotten away with that a few months ago.
For sure. And people making decisions online only, buying houses. I'm watching that happen right now. People just like, you know what, I'll buy it. The pictures are good enough.
That was already happening last year,
yeah.
right? But it's definitely accelerating now. Like, I want to be there. That house looks nice. I can look at the aerial photos. I can see enough stuff. You did a nice 3D tour. I'm in, right?
I'm going to be interesting to watch that chart that you've got, the real wages versus productivity, to see if there's another, because we're really forcing the issue on a lot of technology on people. I work out with somebody who's IT for a county, and he's like, I work 24 hours a day. We've had to go from 0 to 100 overnight, but nothing will ever be the same. So it's going to be really interesting to watch.
Leave it just on some big picture advice. I think we're a little over our.
Yeah, we are. Okay. Yeah.
Just go, but you know, I think a few things that I would say right now is you need to be jumping back in and making stuff happen right now. And if you're waiting for, things to be back to normal, change is the only constant. I don't think we're ever going back to the way things were pre-COVID, just like we haven't gone back to the way things were pre-9/11, right? We're all still taking our shoes off and going through security lines at airports. It's changed. It is what it is. And I would go for it. But another another black swan, COVID getting worse, lockdowns back again, wear a safety harness, right? Like, think about not pushing so far forward, not over-investing so much, right? Instead of going so leveraged on those deals you want, maybe find a partner and take a little less percentage and have somebody else in there with you so that you can afford some shock if, every tenant in your building decides to cancel rent, right? And you can't evict them. That happened.
Yeah.
So, be ready for that. Have enough, don't hoard cash too much, right? Because it's being devalued right now. But also don't put all your cash out there so you have some safety net, right? So just get in there, make it happen, but have a safety net. Always be looking for opportunities and understand there's going to be winners and losers here, right? And so if you're looking at something that's a loser, understand for every loser, there's going to be a winner too, right? That's just what happens in these reflations. And be looking for those losers, looking for the winners, and making sure you're on the right side of that equation. And you know what? Kind of like my short-term rental guy who, as soon as lockdown happened, he advertised in New York, right, for, the New York escape, and rented all 20 of his units, right? You got to always hustle, right? Like, you got to hustle. And now is not the time to not be hustling. I know a lot of people went home and kind of, Netflixed and chilled. But you got to keep hustling. You just got to keep going. And, I think right now, during these periods of change, they are the biggest periods of opportunity, right? More wealth was created coming out of the Great Depression, right, than probably any other point in history, right? So those things that happen, these things that happen right now, they create opportunity. You got to go hustle and find it.
All right. Well, I think with that, let's wrap it up. We're going to be putting show notes on datadrivenrealestate.com. You can ask questions there and find resource links. And if you're on YouTube, I'll make sure to post some notes and some links to some extra resources in there as well. And we'd love to hear your feedback in the community as well. hear maybe some people that you'd like to talk to, for us to talk to on the show. We've got a lot of exciting stuff coming your way. So datadrivenrealestate.com.
And I was going to say, we really appreciate all the questions, right? Like, so a lot of today's podcast, we actually didn't plan to do another one, just you and I. We were going to jump straight to guests.
Yeah.
And all these great questions. And we're like, you know what? We should get out there and talk about this stuff, and then move to guests. So
It's been a great way to launch.
What's the guest yet, or is it still secret?
You know what? I think we are going to have Bruce on, my pops, and I always love hearing you guys talk about timing. John Burns says he's going to come on, and John Burns is such a wealth of information in the builder community and the Wall Street community. Can't wait to talk to him. I
loved what he did with demographics instead of millennials and the rest, doing it by decades. It just made so much more sense.
Exactly. And then we've got somebody from IBM. So we're going to talk about some more advanced marketing topics. So just to start, I've got a list of about 20 that we'll start banging away at in the next couple months over summer. So I'm excited.
Me too. Super excited. Thank you, Aaron.
All right. Until next week.